This is the current federal tax developments for the week of January the 30th, 2017. Current federal tax developments are brought to you by Nichols Patrick CPE, a division of the Lascalzo Institute and your state society of CPAs. This week, we're going to have a little special session. We're going to be looking at the almost proposed regulations that were initially released by the IRS on January 18th related to the Bipartisan Budget Act's new partnership audit regime that will take effect for tax years beginning January 1st, 2018. Now, these have been long awaited because the bill that the Congress passed was honestly very short on details, many of which we need to know in order to understand how these rules are going to work, and most importantly, to allow us to help our clients modify partnership agreements, which probably need to be looked at due to this new regime. Now, this week, we're going to talk about some issues coming up. And one thing I want you to take a look at is we do have, as I've reminded you in the past couple of weeks, some updates coming up in February as we get to the very end of tax season. Wanted to remind you again, if you're in Ohio, we have 4 different days coming up where we're going to have a federal tax update for industry presentation on February 14th in Cincinnati, the 16th in Toledo, the 17th in Cleveland, and the 24th in Columbus and via webcast with Butch Rogers. And then I will be heading to the Portland, Oregon area in Beaverton to be putting on a business and industry tax update session on February 28th. These sessions are designed for those of you who are in industry to give you the ideas of what's been happening in taxes that may be of interest to you in your business. So if you are in that area, or you're basically that your area of expertise, you're in private industry, you might consider looking at one of those courses and signing up for them either in Ohio or Oregon. We certainly would look forward to seeing you at either one. Well, the regulations came out, and then they didn't come out for the proposed regulations. They were initially issued as Reg 136118-15 back on the 18th of January. But the problem is, and it should be 118, I should say, of 2017, not 16, if you're looking at the slides on the screen. Always bad when the year changes. But they were issued to explain the Bipartisan Budget Acts changed the comprehensive changes to the partnership audit rules that were part of that rule, of that particular law. They were meant to replace and would replace entirely the TEFRA partnership examination routine we've all come to know over the past many years. The idea is that these will just take over. They will make it easier for the IRS to audit partnerships, and that's Congress's goal, because the idea was they're going to raise money this way. Now, they were issued on the 18th, but then this week the IRS announced that they had essentially pulled them from being published in the Federal Register. Now, that's not because the IRS had a change of heart regarding these regulations, but it was more directly related to the fact that you may remember we had a change of administrations last week. And that means that the new administration coming in, as has been true for the last 2 times we've had a change of administration, walks in the door and just essentially initially says, you know, put a hold on all the regulations that are in process right now. And we want to review those that took effect toward the end of my predecessor's term, because we want to make sure that somebody wasn't trying to pull a fast one on us the time before. So this is the 3rd straight time we've had this happen. And as always tends to happen in this case, some things just become kind of collateral damage, that they aren't really what was being aimed at, but they show up. Those of you that are old timers may remember the IRA, inherited IRA rules that we all thought were wonderful, that temporarily disappeared when George W. Bush came into office, because they were within the time frame when he wanted to go back and look at the old regulations. Well, we're back with kind of the same thing here. But given the fact that these regs are absolutely required in order to explain a law that, to be totally frank, Congress left tons of holes in, that we have to have regulations to implement this regime because Congress left way too many things unexplained when they passed this back in November of 2015, and the fact that the IRS doesn't really have time to start over totally and rewrite from scratch, since these take effect on January 1st of 2018, where we have to have those for tax years beginning January 1st of 2018. Seems like probably these regs are going to be, or something very close to them, are going to be at least the proposed regs that will be issued for discussion purposes. Now, Congress is considering a technical corrections bill in this area, and obviously some things can be added onto that. And frankly, with the proposed regulations, Congress may decide to override the IRS on some of the proposed areas just by simply legislating out, which wouldn't be a bad idea if we can actually get an explanation and, and something in place. But it still seems very useful to take a look at these regulations and try to figure out what they mean. Now, the actual regulations went on for 277 pages. They're not exactly short. And today we're going to cover them, but I'm going to briefly cover them. We only got about 25 minutes to cover here. And frankly, it would take a much longer time to do a deep dive on these regulations. So what I'm going to suggest you do is we'll talk about some of the highlights here in today's session, but I also have written up, available on the website, a 64-page update that will tell you in much more detail, look at each of the regulations that were released on the area of the partnership audit regime. And you can then, spend time as necessary taking a look at what might be affecting your clients, because all of us are going to have some conversations with our partnership clients about how and in what way their particular partnership structure may need to be modified to take these new audit rules, which could apply to any partnership, into account. Now, one of the key things here, the basic of these new exam rules is pretty simple. The new regime defaults to assuming that we're going to audit the partnership, and then when we get our adjustments, we're going to impose a tax on the partnership, and the partnership would pay that tax. Some small partnerships will be allowed to opt out, and the regulations tell us about that too. The partnerships also, if they don't elect out or can't elect out, they can still elect to push the adjustments out to the partners, and that's called the alternative to the imputed underpayment. The TEFRA rules, as mentioned earlier, are fully repealed, so everything you know about TEFRAs kind of goes away. And they are mandatory for tax years beginning after December 31st, 2017. They are optional for any exams you have for tax years that began after November 2nd, 2015, and before January 1st, 2018. So you could elect to use them. So might be important because you may want to elect to use these if your fact pattern were right. Now, some things we have here, one of the big things, and one of the few things that has generated a bit of controversy about these regulations, is the IRS's reading of the scope of the rules. This is found primarily in proposed regulations 301.6221A-1, where the IRS outlines what they mean. Now, according to the rules, this covers all according to the code, this particular audit is going to cover all items of income, gain, loss, deduction, or credit. And the IRS defines that to mean anything that goes or should go on the 1065 or otherwise is required to be reported by the partnership under Internal Revenue Code Section 6031, even if not actually reported by the partnership on those forms. But the IRS goes a bit further in this case. The IRS also tells us that essentially, among the various things that they will review, they're going to review everything related to partnership. And in fact, in many ways, they're going to start taking things that under the TEFRA rules had been items that were decided at the partner level in a TEFRA exam. We're going to start pulling those up the partnership. One of the key ones that's mentioned by the IRS will include all penalties, and by that means including partner level penalty findings, which means that the partnership is going to have to present the case for the individual partners to potentially get out of penalties if the partnership itself can't justify it. That is, a partner could have reasonable cause even if the partnership didn't. So this is interesting because previously we had that particular discussion. Now it won't be there. Also, it makes clear things like partners' capital accounts are part of this. We also have issues looking at any other sort of transaction between a partner and a partnership, the amount of liabilities, everything basically is on the partnership return rather than necessarily just the items of income, gain, loss, deduction, or credit. And the IRS's view should be covered. Now, the IRS determination was that Congress meant for this to be very broad, and there's no reason to believe that it should be less broad. than what we have under the TEFRA rules. Now, the IRS next goes on in Regulation 3016221B-1 to talk about the case for partnerships that can elect out of the BBA audit regime. Now, those are small partnerships. They're defined as ones that issue fewer than 100 K1s and that have only eligible partners, with eligible partners being limited to, effectively, partners who are individuals, C corporations, foreign entities that would be taxed as a C corporation if subject to U.S. tax, S corporations, and estates of former partners. Now, the IRS makes it very clear that they plan to very strictly limit that option out. By that, the regulation states right up front that disregarded entities will be considered to be a type of partner that will kick you out, even if the disregarded entity drops it otherwise through to an individual. Now, they say trust. They didn't say grantor trust specifically in the regs would disqualify you, but based on how TEFRA was interpreted, they had always taken that position there. Seems to be little reason to believe they won't take that position on this regime. There were a couple of clarifications on the 100 or fewer partner test. Number one, we do count K1s if you have an S corporation shareholder. Let's say the S corporation issues 10 K1s. The IRS has interpreted in counting the 100 K1 limitation, instead of ending up with just 10, taking the one S Corp K1 out and substituting the 10 K1s for the shareholders, you're rather going to have 11 K1s. We're still going to count the K1 to the S Corp, but then we're going to count the other 10 on top of that, so it would be 11. Obviously, this could push you over the edge, especially if you have a number of S Corp partners, because you're going to be adding one extra partner every time there's an S Corp partner there, as opposed to having those shareholders hold the interest themselves. One other interesting clarification put up for eligible shareholders. The IRS, the eligible partners, I should say, the IRS did make it clear that an estate that obtains its shares after, or its interest after the death of the basically the decedent, that estate is going to be an ineligible shareholder because the law says the estate of a deceased shareholder, that's no longer the estate of a deceased partner. The deceased person in this case, whose estate it is, never having been a partner, that estate will disqualify you. The IRS also notes very clearly, and they warn people that if you think this is going to be a way out of getting audited, the IRS is going to rattle a few sabers here. They claim that they plan to increase examinations of partnerships, both that are under the new regime and those that opt out and try to go under the pre-TEFRA rules. They also indicate they're going to be checking because they believe people might be using this as a way to dodge or evade notice. So the service, now whether they'll actually do this is a different question and how much they do, but they are making noises since a lot of people, myself included, look at these rules and think, well, the IRS loves these centralized bits so much that the odds are they won't actually examine the non-centralized one. That may still be the case, and the IRS may simply be saber rattling, but it is important to note right now that they definitely are rattling that particular saber. Another thing that has to be brought in here is we have rules for consistent treatments of items by a partner in the partnership. This is similar to what TEFRA had, except it's a bit stricter that we have. As with TEFRA, a partner is required to report consistently with the partnership unless the partner files with the IRS a notice of inconsistent treatment. The regulation makes clear that when you file that notice, you better clearly specify every item that you are being inconsistent on. The IRS makes clear in the regulations that if you don't specify every item, they're going to hold you to anything that wasn't specified in your notice of inconsistent treatment. If you take that position, what happens then is, instead of you being bound to the partnerships level, the IRS rather would have to examine you personally and examine that position from your position. to see whether or not it makes sense on your return. Now, that may or may not lead to an examination of the partnership on the same issue, depending upon the reason why you have this different treatment, but you have to have it. The regulation also makes clear that if you have not filed a notice of inconsistent treatment, you can't later try to do something along those lines if an administrative adjustment request or or basically we have an exam come down, that you can't bail out at that point. You're kind of stuck with where you are when you file the return. You decide if you're going to be in or not. If we have an underpayment resulting from inconsistent treatment, then basically the IRS can just go and change the return automatically. This is considered a math error, pure and simple. There is no right to do what you can do with most math errors, which is ask the IRS to remove the math error and then get it back under the standard deficiency procedures. That's not available for this one. And the IRS effectively means they can just go straight after collecting the tax in that area. They do not have to wait for any sort of appeals period. Okay. Now, the next up, what the government did was we have an issue here dealing with the appointment of this person called a partnership representative. The partnership representative takes over for what was the tax matters partner in a TEFRA exam. And essentially,